Hi, today we're going to look at the 2021 Unit 2 Question 1. So as usual, let's get our act together and get this paper going. Alright, so the first question was to define each of the following terms. So there are two terms and we're getting 2 marks each. So the first term was to define disposable income. Now, what's disposable income? It's the income remaining after all deductions from your salary have been made. You know, all the taxes, all your necessary expenses like your water bill, your telephone bill, your gas bill, whatever, your food, etc. All those things have been deducted. Whatever's left over is your disposable income. So basically, that is a portion of your income that could be spent, saved, or invested at your discretion. Right? You can do whatever you feel like with it, right? Go to the movies, eat out, splurge on something new. Basically, disposable income gives an idea of your financial well-being. All right. The other term was to define net national income. All right. So net national income is the total income earned by the citizens, the residents, the businesses, and the governments of a country. Plus income, the net incomes from abroad, and then you would take away from that the depreciation of the country's capital stock. And of course, if you want to push it a little further, you would also take out the indirect taxes levied by the government. All right, so we can write that then as NII, net national income, is equal to the GDP plus the net incomes from abroad minus depreciation. And as I said, you can stretch it out by taking away the indirect taxes as well. All right. So that is question 1 and not question 2. I don't know why I put question 2 there. So question 1B, explain the concept of double counting. Now we know that double counting is a phenomenon of national income statistics, right? Especially when you use the expenditure method. And this is because consumption of the same inputs, when they are passed on from one entity to another, are repeatedly included in the calculation of final goods. All right, maybe an example might give us a thing. So for example, a cane factory sells its sugar to a drink manufacturer who uses that sugar to make Morby products, right? So they put it in their Morby products, which are then sold to the supermarket. So clearly then, if the sugar is included in the factory's final goods, and then you turn around and include it in the manufacturer's final goods of that Morby product, but surely you're counting the same sugar twice, hence double counting. Right. The other question now, part B2, says, using an example, explain the concept of marginal propensity to consume, MPC. So the marginal propensity to consume examines the idea that individuals will use some portion of any increase in their income to consume more goods. Otherwise, they would save it, right? So therefore, the MPC plus the MPS will be equal to the total increase in their income. For example then, so if a person's income was increased by $200, and they spent 150 on consumption of goods, that would suggest that their marginal propensity to consume is 75%, right? Because the portion that they spent out of that additional income, they spent 75%, right? Now, so part B3 now says, well, okay, so you're given this information relating to the aggregate expenditure of the economy. So we have consumption, investment, government spending, etc., with some figures. And they're asking us to calculate the level of income. All right, so income, if you recall, in a domestic situation is simply consumption plus investment plus government spending. So if I were to expand that, right, income would then be the consumption function, right, C plus BY. Remember, the BY is that portion, that induced portion, that marginal propensity to consume, plus investment plus government expenditure. So if I were to separate the common variables, I just done this long for purpose, right? If I were to separate the common variables, then we will rewrite that statement as y minus by equal the small c plus I plus G, right? Investment plus government. Now that small c, remember, is that compulsory portion of your consumption, the part you ain't got no choice, right? So therefore, we can now say that income then is small c plus I plus G divided by the marginal propensity to save, right? Because that would be the opposite of the consumption. So hence, if I substitute those values, we will get 100 plus 300 plus 60 divided by 0.2, right? Because the MPC was 0.8, so therefore the MPS is 0.2, giving us that the level of income here is 2300. Now, of course, we could have just put 1 over 2 and multiply by the 1 over 2 is 5, and we could just multiply by the multiplier. So for 60 by 5 will give us the same 2300. All right. Last question, I think. So this is the last question here. It says, discuss 3 limitations of national income accounting. All right. So 1, national income accounting information only captures officially recorded data. And even that data by itself is not fully reported, because we know, lots of businesses don't really declare a lot of stuff to the government, right? And nor does it include information from the informal economy, the street vendors, the self-employed people. Well, these people don't report their information to the government, so therefore it's not going to show up in the statistics. Neither does it even attempt to capture non-market activities such as household work, right? Volunteer work, or even illegal work, like prostitution and sale of drugs, etc. These things don't appear in the stats, right? So therefore there's a limitation to, or it could be an underestimation of the performance of the economy. Another limitation is that it does not make reference to the negative environmental impacts on the country's economic resources, because you're going to use up your the natural gifts that were given, including your land. You're going to have wastage of one resource in pursuing the development of another. And then there is pollution, noise pollution, air pollution, water pollution, environmental pollution. All these things are the result of you trying to maximize the usage or profits from another set of resources. And the third point that I will probably put here is that it is not a good indicator of the quality of life or income distribution in a country. And so what happens is that the national income information gives you a generalized position without reference to the major subsectors of the country. So clearly then a high GDP may be heavily skewed toward, in favor of the rich 10% in your country, and thus creating a false impression that there has been poverty reduction when in truth and in fact it's only the people like thought that get the money, and you still got a large base of people at the bottom who are earning nothing, because you and I know that the top 10% are probably the ones who own all the capital and natural resources, or who own the resources to make the money. And so when there's an increase in the GDP, it's they who are getting the money and not necessarily the people at the bottom. All right, so to me, that's my 3 answers to that question. And that is also the end of the question. So I just want to thank you. And then in the next one, we will look at question 2. But until then, you keep revising. Okay?